Good afternoon, everybody. Welcome to the second of our two webinars for the month of February. My name is Jonathan Wu. I'm the Executive Director and Chief Investment Specialist for the Premium Funds Group. And we certainly welcome you joining us on our webinar today, especially talk about a rather unique asset class and what that holds for investors going into 2022 after what is a more turbulent year. And I'm going to sort of give quite a bit of detail as to what the macro environment we're currently facing and how we currently positioning our portfolios to take advantage of that, because what we see is that China is going through what is a counter-cyclical policy maneuver that's very different from the West, and we'll sort of deep dive into that and sort of see what the consequences of that from a portfolio construction standpoint and how that's relevant to your investors. So I know there's a number of retail direct clients on the call today. And everything that I talk about today is obviously of a general advice nature only. If you require advice, please seek the advice of your financial advisor. So just a quick update on Value Partners, our multi-award winning team in Hong Kong. They've now hit 28 years in running money for investors, again with the same principles, which is fantastic. And even as at today, with the $10 billion that they manage, which is around $6 billion in equities and $4 billion in fixed income, they are the single and only listed asset manager in Hong Kong, with still 43% of the equity of the business still owned by the principals, management and co-founders, which aligns the interests of you as investors, as well as them as the stock pickers and bond pickers of the group. Our investment team prides itself on the fact that we are living in Asia, which is a very, very different investment environment than the West. That's why we've got 70 people purely in the investment team running around looking for the best of ideas for investors over the long term. And with offices being in Shanghai, Shenzhen, Kuala Lumpur, Singapore, London, and Beijing, it means that we do have global coverage. We do not profess to understand or do well in non-Asian markets. We are an Asian fund manager and an Asian powerhouse. That's reflected in our performance. And we don't try to be, all things to all people. So while we are niche, we're also very, very good at what we do. And for investors that are looking for an active approach, especially in Asia, and the sort of the pitfalls that a lot of people have gone trying to go down the index route or trying to go down the cheapest route, it's been rather detrimental to investors. So we are a fundamental relative value manager. That does not mean we just go out and buy the cheapest things. Some of the reflections we had from the equities webinar yesterday was, reflecting on Alibaba, and while there is a great business, it may not be priced very well. And our CIO in fixed income, Gordon, has always said something very, very, poignant and very frank with investors and advisors, is that if something is priced so badly, I might buy it. Okay, there's never such thing as a bad bond. There's only a bad price that you pay for it. Now, in terms of our fixed income team, it's made up of 11 members. There's been a couple of new joiners inside the research and strategy team specifically. One of the key strengths that's been bolted on over the last 24 months for the team is the creation of this research and strategy team headed by Anna Ho. And Anna's background is very, very strong, because it's very rare to find someone from the sell side part of the universe being able to actually present in direct investment cases. So usually you either have someone that's very good at strategy and says, okay, we should now have a look at the commodity sector because commodity prices have been really high, or we should have a look at the logistics sector because shipping prices are really high, but doesn't necessarily have the ability to dig further down into the detail of actually presenting, okay, the logistics sector, shipping costs between Shanghai and Los Angeles have gone up tenfold on a pre-COVID comparison basis. Let's have a look at these six companies, right, and the bonds they're trading at. So what Anna and her team has been able to enhance the portfolio management team is that basically providing with more ideas, and which allows that the portfolio management team to spend more time on portfolio management, making sure the sizing of the individual bonds are right, we're not overexposed, and also ensuring that our trading teams actually being able to position the sizes so that we're not in a position where we run liquidity risk, for example, which, can happen at certain points of the cycle, especially when you saw, in COVID, March 2020, the whole globe's liquidity in fixed income just evaporated, not Asia specifically, but these things can certainly happen, not only just in Asia, but across the world. Then we've got the business management team, which again, really rarely you see actually a lawyer inside a fixed income team. That's the reason for that is because we need to ensure that we are completely over any cross-collateral, cross-default clauses, or anything that is slightly unusual about a deal. That's where Alvin comes in and really digs into the micro detail. So our fund is very, very different to your traditional fixed income fund, right? We understand it's not for everybody. That's perfectly fine. But what we provide is that added level of depth of research, as opposed to just saying, okay, we are a high yield fund or we are an investment grade fund. In actual fact, over the course of the 11-year history of the strategy, we have been invested in investment grade, we've invested in high yield, all parts of the spectrum of the market. It's where we find the value that's most important and the research that ultimately backs it. So the strategy is primarily driven by high yield, but we do have investment grade in the portfolio. And during COVID, we had up to 20% of the portfolio in investment grade solely because we wanted higher quality at that point in time. And we wanted to ensure that we were well balanced in the portfolio to deal with any potential headwind risks. At the end of the day, we are still a fixed income fund. We are still more conservative than our equity counterparts at Value Partners. But we certainly are still trying to find that balance between achieving the yield target since inception that we've had of 6%, and still trying to generate returns both in two ways. Okay, so the first way is to get the yield. The second way is to get the capital gains attached to it, which I'm going to spend a little bit more time on now, because for the first time in 2 years, we are now presented with another new opportunity to get in. It is a buyer's market at the moment with regards to choosing really high quality bonds priced really inefficiently, and basically riding that capital gain opportunity as the sort of market reacts to better earnings, better rhetoric, better policy, and we'll talk about that a little bit later as well. A small part of our portfolio, which we've made very clear over history, is that we have 6 to 7% of the portfolio that can be allocated to special situations. That could be Israeli sovereign debt, where it's paying 3-ish% on a face yield basis issued on the primary market. But because of the fact that the thirst for yield hasn't stopped, we make 7%. So the bond trades at $100 at par value, then it went to $107 in a week, we sell out. That's a special situation. On the other hand, there could be a special situation, Mongolian mining deal, where the Mongolian government was quite close to bankruptcy. We did all the numbers. Mongolia is a very rich resource country. One of the best bonds to buy is their mining bonds. We got in very, very cheaply, made about 50%, get out. Okay, those are those really quick trades, but those only ever make up a maximum of 7% of our portfolio. So, we screen the bond market and we try to find everything that pays above 6%. Now, historically speaking, things that paid less than 6% were actually property bonds, because the property sector was the part of the market that provided the most amount of security, which means that on a risk return basis, those property bonds and the way they market them in the market didn't need to pay that high level of interest. That situation has changed now. And then that's allowed our portfolio to also diversify. The reality of the market is the entire Asian fixed income market, 60% of it are property developer bonds and property manager bonds. So it's not a part of a sector that you ignore. It's the same thing when you look at banking sector in Australia. They make such a large part of the S&P 200 that everyone quotes they're underweight or overweight, but you simply cannot ignore it. And for us at the moment, our portfolio, which I'll talk about a bit later, is about 25% in property, and we'll go into a bit of detail there. We are focused on the bottom-up credit analysis. We are not interested in top-level sell-side research. in determining where we want to buy. We also don't buy on the weight of money. And we also try to ignore markets that are overvalued. So in Asia, traditionally, one of the only places where developed market fixed income managers may allocate some level of investment into Asian bonds is actually in Indonesia. Most of the time, and I mean 80 or above % of the time, we find that market very expensive. And so for us, we need to be able to find value for investors by not buying bonds that are trading over $100 on par value. And that's the risk, or the headwind risk, that buying developed market bonds is you're going to face going forward. And even most fund managers that I've seen, taking sort of my fund manager hat off and putting on the advice hat, most fund managers are predicting somewhere between 1 to up to 3% losses on traditional fixed income funds going forward in the next 1 to 2 years, solely because interest rates are going up. So for us, we're trying to find those bonds that are, at least paying 6% yield in order for us to generate the yield that you're after. But at the same time, because the spread between the risk-free rate and our bonds is so high that even as rates increase in the Western world, the impact will be quite low to our portfolio. And given this current state of the market, you'll see in a minute why that the downside risk from here, we believe, is relatively minimal. So we focus our portfolio on buying, bonds that at least have a fundamental score for us on our analysis based on this scorecard of at least 4. Okay, and a lot of this data we drag out of Bloomberg in order for us to help form our opinion on things. But what's very interesting is that we, depending on what we're trying to do with the bond, so we're either trying to hold a bond for yield, we're either trying to do tactical trading like this example shows, or we're trying to make a capital gain. Okay, because the bond is trading at such a low level. So a lot of the bonds in our portfolio at the moment is trying to hold for capital gain, less to do with yield because of the current dynamic nature of the market, which is great. So for investors that are getting in at this point, it provides an entry point that is attractive relative to what has been trading, for the 12 months before that. The previous time period where it provided a very attractive time point was actually just after March of 2020, and I'll sort of reflect on what that number looked like a bit later on. In terms of where the world's going, there are sort of 6 fundamental drivers of systemic global change. We've obviously firstly got geopolitics, and notwithstanding that, geopolitics is now also submerging itself as part of the Ukraine-Russian conflict. But if we take that aside for a minute, I think we can all agree that the US-led world that's been around for the last sort of 60 or 70 years is now over. It's past. We're not saying that the US is going to go hell in a basket case sort of scenario, but the US will lose its global superiority as being the single, what we call engine drive of the world. It's going to be a multilateral, and which is why we are always for globalization. And we need to sort of reverse the anti-globalization or deglobalization trend that we have been going on for the last 3 years and sort of revive that, because that also has had flow-on effects to inflation, for example. And so China and the US and a few other countries are going to be part of a multilateral world generating growth going forward. And when you then look at that from a portfolio positioning perspective, whether it be from equities or bonds, the balance needs to be better. Then we've got the environment, which is made up of climate change, pollution, loss of biodiversity, which affects the world. We've got a demographic disruption issue, and if you use Japan for an example, recently I was reading a study on it, that by 2040 it is expected that half of the population of Japan will be living single, which creates huge problems for pension sustainability. Then we've got demands for social inclusion, and this is probably the greatest ethical demand of our age. What China's going through at the moment is this common prosperity push, and I'll delve into that a little bit later. We've got smart machines and digital society, so we're talking about digital currency, we're talking about things that create better time cost compression in economies like China to make it more efficient, and that's through building more high-speed rail networks, for example. And the final thing is wealth and well-being, because the quest for well-being is sort of the primary focus of most people post-COVID. Because as societies get richer, just finding out that the GDP per person is higher than somebody else's doesn't actually define what is well-being. So the quest now is for an increased quality of life. So both on our fixed income and equity teams, we try to delve into these 6 systemic fundamental drivers of change and see how we can capitalize on that. This chart just reflects what I described before about the China and the US relationship. China is now already the world's largest economy 5 years ago on a McDonald's index basis, and that, that on an absolute scale will change over time as well. If we then now focus on China's policy fine-tuning, which will lead into sort of the bond markets, we expect that next month is sort of going to be the next trigger point for us to start making more investment decisions, because they're going to have their National People's Congress, which is made up of 2 sessions for the plenaries. And we suspect that they'll target a 5% growth. We also suspect that there's going to be further easing on the policy side. So what we saw in January is that we saw the special government bond issuance, which is the ability for the government to order or allow the local governments to issue more bonds. They basically front-ended their budget much earlier in the year, which gives us the signal that the government is trying to go for easing this year, because last year they delivered, all the nuance of a sledgehammer with regards to the policy around common prosperity and attacking monopolistic behavior, which no one actually in the world disagrees with. And this is the interesting thing. You may like to criticize or consider criticizing, especially in Western media, about China, using its one-party democracy system to implement policy as it likes. But in actual fact, no one disagrees with the policy, because it actually provides society better well-being. They're trying to achieve what we like to call adjusted capitalism. So going forward, you're not going to see a new Jeff Bezos, you're not going to see a new Jack Ma, you're not going to see a new Mark Zuckerberg, right? Does that mean you actually can't be a billionaire? Of course not. That's 2 very completely different things. The problem that China has seen in places like the United States is that the populist movement came about because people were unhappy with their level of wealth growth, and that they feel that they're missing out. So if you consider the Gini coefficient of China and the United States, it's about the same at 0.4, but the difference is China is doing something about it, whereas the US simply is not, and all the debt to go with it. So we expect this year that we're going to see probably continuous rate cuts where China can, because their policy rate is 285 basis points. And we'll also expect to see that the RRR cut, which is what you can see in this green line on this chart, to also continuously fall. The RRR, or the required reserve ratio, reflects the amount of tier 1 capital banks need to hold as a reserve and do nothing with it. So basically, if you reduce the RRR, you are actually injecting further liquidity into the system. So if we consider, where China sits compared to the United States, we believe China is a safe haven for investors. Now, that seems to be a very, very left of field statement. Go, Jonathan, you've got to be kidding yourself. But if you fundamentally look at this, and if I swapped the US and China in the 2 opposite direction, and if the United States was trading at, currently going through 90 basis points of inflation, have a central bank rate of 2.85%, looking to decrease interest rates this year, it's going through austerity measures to create more sustainable growth, and they're trying to create better social inclusion by coming with common prosperity. Everyone will be saying, fantastic, that's where we want to invest. But solely because it's led to the word China connected to those characteristics, everyone goes, no, I don't want to be part of that regime. What's wrong with the word regime has a negative connotation? All that means is that it's reflective of the one-party democracy. Where the United States is now facing a lot of headwinds, which is then driving those negative forecast returns for traditional fixed income funds, especially in investment grade, as interest rates rise, it's not rocket science, that's exactly what is going to happen, is the issue we see in the United States is that they're already behind the curve with regards to increasing interest rates. Which means that when you finally increase interest rates, as we expect they will do this year, they're going to have to do it very aggressively to hone back the 7.5% inflation. Now, as we all know, if you exponentially increase interest rates and you ramp them up very, very quickly, your direct impact on growth is also going to be a lot higher. At the same time, there is a gigantic risk of the United States in that there has been no austerity measure implanted since the GFC when Lehman Brothers collapsed. None whatsoever, which means every time the United States has taken the policy between the Fed and the government to basically kick the policy down the line to the next set of problems. And then furthermore, the United States is not addressing the Gini coefficient problems. By contrast, as I said, China and United States Gini coefficient is about 0.4, Australia is about 0.5 because we have such high levels of social security. But the United States and China, only one of them is doing something about it. So which is why going forward, China is facing much less headwinds than the United States at this part of the cycle. Then let's look at the opportunity and how that translates. What you see on this chart is that the number of standard deviations between the Asian high yield spread and the China high yield spread against the risk-free rates. Now, for those of you that are on the call, I recognize that quite a number of you that are currently invested, I showed you a chart that showed 6 standard deviations away from the mean for China high yield spreads back in late 2021. And everyone then said, wow, that's incredible. Now, let's go back to Statistics 101 from university. What does 6 standard deviations mean? Let's take one step back even further. What does 3 standard deviations mean? 3 standard deviations means there's over 90% odd, I think it's 96% of all possible return outcomes is 3 standard deviations. If we go to 6 standard deviations, it's 99.9999999% of all possible return profiles. What that reflects is that it reflects the inherent risk the market is pricing for the China high yield securities market. Now, overall, yes, that reflects risk. But in our viewpoint, if you are an active manager, that prevents an incredible amount of opportunity. Things have calmed down now from being 6 standard deviations to now 3 standard deviations a week ago. This chart was updated to a week ago, right? And Asian high yields, it's about 2 standard deviations. This is an incredible reflection of how extreme things can get before they will get better. Then if we consider what is the bond valuation and comparing the China story and the Asia story to the rest of the world, China and Asia is still far above emerging markets. And here is the kicker. Emerging market debt is majority made up of Asia. The majority of emerging market equities is majority Asia. The fact that people want to allocate to emerging markets always leads us to have a lot of questions because, again, you can't be very good in all markets. Our viewpoint of the world is that you need to specialize in those markets. And when China is providing a 20% yield to maturity, which is what it's currently pricing in at the moment, versus even EU high yield of 3.5% or even the US high yield of 4.7, this is the all-in total return. This is not yield. This is yield to worst or yield to maturity. It's the all-in total return of yield plus cap growth or cap loss. That's where the market's pricing at the moment. Then let's look at this chart that I built about 2 years ago and updated every single month. This is data now for ending January. We're getting close to ending February. What is the market telling us? The market is telling us is that if you invest in a diversified index portfolio of Australian government bonds, you'll pick up 2.6% yield and you'll make a 1.6% yield to maturity. Now you're all scratching your head if you haven't been to my previous webinars and say, so if I invest in Australian government bonds at the moment, what does that actually mean? It means that if you buy into that portfolio today or the end of January, you're paying $107 for a portfolio of bonds that at maturity will give you back $100. That portfolio at the moment, that index portfolio, has a time to maturity of 7 years, so it's quite long drawn. So on average, you will lose about 1% a year. Now, despite Russia and Ukraine, despite increased interest rate environments, you would go and say, oh, okay, Jonathan, that means, okay, clients need to be more defensive. We're uncertain about the future. What do we do? Let's go defensive. So your defensive options are those 2 that you see on the screen there. Australian government bonds, international government bonds. I won't go into the detail of international government bonds because it says the same thing. It's just less severe. Then what we're saying is that our portfolio at the end of January is running a cash yield of over 6%. It has a yield to maturity of 16% with a time to maturity of 4 years. So we're looking at capital gains of about 10% per annum based on the static portfolio of where we sit today, with the average purchase price of our portfolio $68. Okay, so if you go and make a trade on the 1st of February, you are buying a portfolio of 80 bonds with an average price of $68. As they mature over the next 4 years, you're going to get $100 back on each of those bonds. That's what we're telling you. Okay, you can't forecast equity returns. That's just dangerous, right? What we're saying is we're presenting a binary 0-1 case to you today and saying the average purchase price of anyone going into these bonds today is sub $70. If you're allocating to the other two, it's a very, very different scenario where you are paying more than they're actually worth. Now, we've still got about a quarter of our portfolio in the property market, so let's address the property market. What's actually going on and what's the government trying to achieve? The government is trying to ensure that the property market is sustainable. What does it mean by sustainable? The Chinese government wants to stop seeing people speculate on property to make capital gains as opposed to actually buying property to live in. How's the government done that? Number one, they implemented the 3 red line rule, which I won't go back to because we've covered that in many previous webinars. So you're basically forcing developers to deleverage their balance sheets in a very, very quick way. And then you're also cutting off certain levels of debt that they can continue to raise into the market. What does that do? Not rocket science again, it's going to slow down activity. You slow down activity, you also put a brake on mortgage approvals. Then you obviously put the brakes on demand. And as you can see on the chart in 2021, after June last year, because the Evergrande situation started happening in July, you can see that the property sale on a monthly basis has significantly dropped compared to what it was seen in 2020 or even 2019 levels. Okay, that's not a bad thing. There was a question yesterday about, if going forward the government can't sell much land anymore, then how are they going to sustain themselves? Well, number one is that they're going to issue more special bonds. Number two, the government is currently looking at other ways to also curb speculation in the property market vis-a-vis implementation of some form of property tax, whether it be high levels of stamp duty. They sort of toyed with the idea of reducing stamp duty over time, depending on how long a property has been held, as well as capital gains tax. We believe that these will be progressively implemented over time to sort of smooth out policy implementation risks and also a direct hit to the market, because the government, has realized that the blunt sledgehammer that they took last year seriously blunted the market overall. And if we look at new home prices month to month, we finally saw in the latter half of last year, the rate of property price decline, right, across all tiers of cities in China, 1, 2, 3, everything major, the level of property price drops hasn't been seen since sort of early 2014, okay? I'm talking about all tiers of cities. This is healthy, right? We expected at some point in time the government was going to implement this, and we adjust our portfolio accordingly. So this is where our portfolio stands. Now, I want to address something that's good, probably the biggest elephant in the room for those of you that have been on our journey for quite a while. What you see here is that the return profile of the fund looks like a pretty straight line up until August of 2021, where our 6-month performance is negative almost 10%. Right? We're not shying away from that. For the first time in the history of the fund was not able to activate the foreign exchange or the active currency hedging strategy that Gordon has to be able to defend the mark-to-market movements. If I use the previous crisis point of the COVID crisis, so on the screen here, which is March of 2020, the fund fell 7.3% in a month. What did that tell us? In actual fact, if we base it on a mark-to-market movement, the fund actually fell almost 15% in a month. Remember, it's all high yield securities. So how did we end up only losing less than what investment grade funds lost during COVID? Because of active currency hedging. Our fund was zero hedged as the Australian currency got smashed and corrected quite heavily from about 70 odd cents to 57, but it was a global event. Whereas this time, because it's a China-centric event that's caused this correction, the Australian dollar hasn't moved. So whether we took a active currency approach and hedged or unhedged, it didn't actually make any difference. We basically, this time, on behalf of investors, we have taken the full brunt of the market-to-market movements. Now, whether we are referring to this period or referring to the previous period, both of those, I want to make it very, very clear. Not a single one of our bonds have defaulted. And all this is a mark-to-market movement based on lack of confidence. We have seen this before. And if you look at the small blips that we've seen over the history of the fund, we've seen this a number of times. It's just that you may not have noticed because we've used the currency hedging as a buffer. Right now, we are around 10 to 15% hedged, okay? That's where we stand on our viewpoint. But as we said, these 84 bonds, if you bought in today, you are buying at an average price of $68. In terms of our sector exposure, as I said, 25%. Sorry, I forgot. We're actually jumped to about 31%. That's off the highs of what we used to be, which is around 65% of the portfolio was property, and we got all the way to about 10 to 15%. What we've done as part of our research process now is specifically for real estate, is that we've broken them up into three different categories. We've got category 1, category 2, and category 3 names, of which category 1 is what we call the ultimate survivors. Strongest balance sheets, has access to the highest levels of cash. So let me talk about cash here. Cash doesn't necessarily mean cash in the real world. You may be a property developer and you may have cash sitting on your balance sheet. What is also true is that you may not actually be able to use that cash if you wanted to, because of the way that people have bought property. They paid their 10% up front. That cash sits on your balance sheet, quarantined, and cannot be used for any other purpose. So cash doesn't necessarily mean cash, because you may have all that cash sitting on your balance sheet. You may have bonds due or coupon payments due, but you may not be able to pay those, because even though that cash is on your balance sheet, you can't actually use it. So we've differentiated a lot of those names into category 3 and some into category 2. Right now, basically all of our property exposure is what we call category 1 names. And then on top of that, you can see our materials, utilities, and transportation basically make up the next 30% of the portfolio. So basically, if we sort of go back 3 or 4 years ago, when 65% of the portfolio was property, we now have 65% of the portfolio is across the first 4 sectors of our allocation. And right now, we find China and Hong Kong still being the most attractive part of the market for us, purely from a policy implementation standpoint. And then you also look at the credit ratings, which is something that is completely irrelevant to us, but we buy when there's good value. So we've gone up what is the traditional quality curve, or what fund managers like to say, we go up in the quality, is that we're now holding almost a quarter of our fund in investment grade debt, almost a quarter. And on top of that, we also have 12% cash, which reflects our ability to move and have enough dry powder as we go through March, as we see what the government's going to implement in terms of policy, and then we'll act accordingly with deploying that capital. Remember, we're holding 12% cash and we're still achieving a 6.7% cash yield, which means that the overall portfolio yield is actually even higher than that at a 100% deployed calculation. And if you then look at our sort of sector reallocation, we are going for the things that are really, really attractive. So last year, you would have heard us talk about, we were really, really positive on materials and transportation. We still are, but the problem is those sectors have recovered. The prices have recovered accordingly. And now we are turning our attention to the Chinese property market again, okay, because the policy headwinds, we believe, are pretty much fully priced in markets. If you look at the equity side of the equation, property as a sector, listed property developers in China are trading, their share prices are trading at down to, some of them are down to 2 times PE and trading at 70% discount to their NAV. Like, you cannot find another sector that's trashed that badly, which then creates the opportunity to invest, which is why you can see since October last year, we have doubled our exposure in real estate because the opportunities have arisen. Our distributions have maintained consistent throughout this whole crisis period. For the December quarter, we paid another 1.5%, and then we expect to pay another 1.5% at the end of March. This is where we stand, even with the huge correction we have seen in the markets against our major competitors in terms of a risk and return perspective. And then if we look and reflect on the best to worst time, that is now changed. Okay, so our worst time periods have changed. Our worst 3 months is currently now, and our worst 1 year is currently now. In terms of that longer term profile, though, you can see on this slide that, despite our year to date and the 1 year figure being, very disappointing, our 3 years, 5 years, and 10 years are still outperforming the Bloomberg Global High Yield Index. And on our 5 and 10 year basis, we are still sitting as a quartile 1 fund. This is what we call a blip. And to have full disclosure, our family is $7 million invested in this strategy. So yes, we're also disappointed that the fund has dropped, and we're definitely not shying away from that. But what I've hoped to do today is explain why that correction has happened. And to be very clear again, we have maintained a 0 default success rate in this strategy for the last 11 years. And everything that's reflected in the unit price today is purely around the mark-to-market risk and the perception risk of the market. So you'll find our contact details for myself and Derek on the screen there. This is obviously recorded like all our other webinars, and you'll be provided with a recording of this in the next couple of days to share with your colleagues that may have missed out. And then we also have our TMDs also in the presentation that you'll get an attachment, so you click through to those and use them as you need to. So I note that there's no questions that have come through on the a question just came through. Thank you. As I said, over the history of the fund, have there been many defaults? 0. The answer is 0. The only thing that I would say that could still define as a default is that we bought a bond knowing it was to default in the very, very short time period because we were looking to go into that restructuring. So as I said, we've never bought a bond where it has surprised us and all of a sudden have default, and that really speaks to the quality of the team and their bottom-up research. I don't see any other questions on the screen. For those investors that have been with us on this journey, thank you very, very much for your support. For those that are currently considering us, as I said, I've presented a very unique case for you going forward for fixed income. Please consider that. Please reach out to us if you have any questions, and I wish everyone a rest of the great afternoon and rest of the week. Thank you.